Hello, everybody. Brian Lockett here, Comprehensive Wealth Management, with a quick update on the markets. This go around, we're going to talk about inflation, interest rates, and the consumer. Now, quick disclaimer, there's not a lot of good information this go around. That's why I want to talk about what's going on in inflation, where interest rate headed, and what is the health of the consumer. I think right now, inflation is in the background. It's all eyes on the consumer. But I don't want you to think the sky is falling. The market goes in cycles. It goes through expansionary cycles and contractionary cycles. Unfortunately, it goes through those expansion cycles far more often than it goes through those contraction cycles. So it's really important as you're listening to this presentation that you recognize where you're at in the investor life cycle. The vast majority of the information I'm going to talk about today applies to the model on the right, the risk adjusting models, whereas the two in the middle, it applies somewhat to, and the one on the far left, the wealth accumulator model, if you're in those strategies, you might as well just go ahead and turn this off. Now, the reality is everything I'm going to talk about is just noise. But for those of you who are in retirement or close to retired, you care about this because you're about to cross that finish line being retirement, or you're already in retirement where it's far more important not to take that large loss than it is to make that big return. Whereas if you're on the other end of the spectrum, you're on the accumulation side of this, what I'm talking about is just short-term noise in a long-term plan. So really, really important, again, to recognize where you're at in that investor life cycle. Now, I'm just going to come right out of the gate here and say this. This is my only slide on the election, at least at this point. We'll probably talk about this more as we get closer to November, but the reality is that the market does not care who the president is. So getting into the actual economics and forecasting here, our general forecast for the overall stock market, both here as well as internationally, is hurricane warning. We have economic data deteriorating. We're going to go into that. We have extreme market valuations. We all know you want to buy low and sell high. Well, right now we're looking at some of the highest market valuations ever. Behavior, investors are all on one side of the trade, that being in stocks. Usually when that happens, it's time to go to the other side of the ship, the bond side of the equation. And interest rates are still high, especially considering where they were a few years ago, which has added a lot of shock to the system, if you will. But on top of that, we have this thing called an inverted yield curve, which I'm guessing most of you have heard us talk about. The bright spot is we have some positive short-term momentum, but long-term and midterm momentum are still negative or flat. So that's the bright spot right now. The question is, will it last? And our hypothesis right now is it won't, and it's because the consumer is struggling. You're going to see me talk about this, but I'm going to just lay it out right now. If the consumer is struggling because they're getting squeezed by inflation and they're getting squeezed by higher cost of borrowing, they're going to have to make spending cuts. If they're cutting goods and services that companies provide, those companies' earnings just went down. Earnings go down, stock prices go down. Stock prices go down low enough, far enough. What do we see? We start to see unemployment rise. And that is the spiral, unfortunately, that we think is coming. I like to call this an earnings-led recession. We saw a similar thing coming out of the top of the tech bubble. It's not going to be one of those flash crashes, I don't think, like we saw where the housing market sold off 58% approximately in about 5 months and gave back 10 years of gains. Nor is it going to be like COVID, where we saw the market drop 34% in 23 days. I think this is going to be a longer, slower, bouncing ball type of drawdown. Not the end of the world. You just have to recognize reality and position for it. Probably not going to be good for stocks. Probably going to be pretty good for bonds, and you're going to hear about that as well. So looking at valuations, there's lots of different ways to put a price tag on companies. And so basically what you can see is all but one method for putting value on the S&P 500. By the way, if you're going to pick an index, this is the one to pay attention to. The only one that's showing it's fairly valued is something called the equity risk premium. Not used that often. Vast majority of the time, you're looking at forward and trailing PEs as well as price to book. So in historic terms, the stock market is expensive. And one of our mantras is expensive things are dangerous. And buying low lowers your risk and creates more opportunity. So we all know we want to buy low and sell high. We think for those folks who are in our risk-adjusted model, we're at highs. Time to get out, go find a new game, collect some dividends and interest, i.e. we're in bonds, while we wait for the opportunity to buy stocks lower in the future. Now, Some of the good news, it appears that the inflation monster has been slayed, at least for the time being. We'll see. What you're looking at here is called the Fed dot plot. So each one of these little dots represents each board governor or Fed board governor's vote. And so what you can see is that consensus is, for the most part, that we're going to start seeing the Fed funds rate, which is the main rate, which things then go off of, like prime rate, is going to be trending down. This will be good for stocks in the short term, should be good for bonds as well. But the reason they're cutting interest rates is because the market, the economy is likely softening, and the Fed needs to be accommodative. And historically, what you see every time we get a cut, you see the stock market rally only because the Fed cut, not because anything improved. And then usually you see the stock market roll over, recognizing the reality as to why the Fed actually cut. So we'll see. Who knows? Maybe history is different this time. But if I had to guess, I think that's the way we'll see this play out. This does look, by the way, very attractive to bonds. Now, one of the things, the market right now is pricing a lot more cuts than the Fed governors are saying. And I think personally, and I know Morgan does here too, that I think the Fed's probably going to pause longer than people expect, because they don't want to make the mistake they did in the 70s where they cut interest rates too soon, only to allow inflation to come roaring back, where they had to raise interest rates really aggressively into the late 70s and early 80s. You guys may remember this. We had double-digit mortgage rates for a few years there. We do not want to go there. It would be an absolute bloodbath for the real estate market, the stock market. We have become very dependent, including the government, on these low rates. So we might just see them not raise rates for a while, but just hold rates high longer than people expect, just to make sure that they have, in fact, slayed the inflation monster. So all eyes on the consumer. At least this is my opinion. I don't think I'm the only one out there, but really what I'm seeing is that people are struggling. I said earlier, inflation's the higher cost of living, and then they're getting squeezed on the other side by the higher borrowing costs. So the reason we pay so much attention to the consumer is a healthy consumer, healthy economy. Unhealthy consumer, unhealthy economy. And this is reflected here. What you're seeing here is the consumer spending has gone down as a representation of our total GDP. So I think of that as the total consumption of goods and services in the United States. The consumer represents about 68% of that. So as I said earlier, healthy consumer, healthy economy, right? Earnings are good, employment's good, but when the consumer's having to cut those expenses, it's going to affect earnings. It has a large domino effect. I don't think it's going to be catastrophic, but it's not going to be better than it was a few years ago, where basically we had expanded unemployment. We were sent $4.5 trillion essentially right to our bank accounts, and we had this absolute spending spree. Earnings were through the roof. We were partying like it was 1999. One of the things that we like to do here is look at the personal savings rate. Right now, it's below 5%, which is sort of the threshold. We're sitting around 4.1%. Again, not the end of the world, but it's just another reflection or another sign that the consumer is struggling. Credit card delinquencies, this is something we really want to keep an eye on, are rising very quickly. And on top of that, the minimum payments that people are making on their credit cards is really rising. And this is, to me, a real problem, because you're looking at credit card rates in the 25% range right now on average. So that's going to become a real problem as people start getting behind the 8 ball. That's only going to continue to hurt consumption. Unless they're getting large raises at work, you're going to start seeing people having to make those cutting expenses, and that will translate to lower consumption. So the restaurant index, this is something I just like to pay attention to. Are more people dining out, or are they eating at home? And what you can see is there's a clear trend. People are not dining out, especially like they were, or at least maybe dining in with food delivered like they were during COVID. The leading economic indicators, think of these as the indicators that have a tendency to kind of project the trajectory of the economy. Is the economy growing or is it contracting? What we're basically seeing here is that for the most part, they are in contraction territory. I said it earlier, the market goes through expansion and contraction cycles. That's fine. Just recognizing where we're at so we know where to invest. That's what we're looking at doing here, especially for those clients of ours that are in those risk adjusting models and they're in retirement. And it's more important not to take those large losses than it is to get that large return. Again, you can see here periodically the economy goes through this, and son of a gun if it doesn't bounce back. One of the things we're paying attention to is how long the leading economic indicators have been in contraction or declining. So you're looking at 20 consecutive months and counting. You'll see here that not in good company. These vertical gray bars are recessions. You'll see here in the 74 to 76, as well as in the mid-aughts, the housing crash. The only two other times here going back to 1960 where we had this long of a decline in these indicators. So what this is really pointing to, all eyes are pointing or arrows are pointing to recession right now. Good news is unemployment is low, but I have to throw a caveat for now, because what we're seeing are the preemptive things that occur before unemployment starts to rise, because companies don't want to lay people off. You know, it's very difficult to find and hire and train these people. So cutting people is the last thing that you're going to see in those leading economic indicators. So what we're seeing right now is temporary staffing is in decline and rapidly declining. Overtime hours are being cut. And lastly, what you're seeing is job openings and job turnover is really, really declining. And so we expect that the next shoe to fall, unfortunately, is going to be unemployment starting to rise. Now, understand, this is all short-term noise and a long-term plan. We just need to recognize where we're at in that cycle. Some more confirmation that we think a recession is coming, if it's not already here, is manufacturing is in contraction territory. A reading below 50 says contraction, meaning there are few orders coming in now than there were before. Right now, though, we do have a little positive uptick in manufacturing, which is good news. However, it looks like services, which has a tendency to lag manufacturing on the up and on the down, is heading towards that contraction territory. For example, that restaurant index I mentioned earlier, that is a good example of something that would be in the services index, which is why I like to pay attention to it. Inverted yield curve, I like to call this the two canaries in the coal mine. So the first inverted yield curve relationship we look at is the 10-year treasury bond versus the 3-month. Take the interest rate on the 10-year minus the interest rate on the 3-month. I should be getting paid more interest on the 10-year than I do on the 3-month. But periodically, that gets reversed. And when that happens, you have an inverted yield curve, which is represented in this chart by the blue line being below the black line. You'll notice that every time the blue line goes below the black line, one of these vertical gray bars appears. Those are recessions. There's not one instance, at least going back to the early 70s, that I can find of an inverted yield curve not being followed by a recession. But I also want to point out two more things. One, you'll notice that the recession does not occur until after it's uninverted, after that blue line goes above the black line. And you'll see today, we're deeply inverted. We were uninverting, then we reinverted, but we're trending upward. But we haven't uninverted yet. So that recession countdown, I would say, has not started. But the other thing I want to point out here, and it's just interesting, I don't want you to get concerned about it, is that the period of time from inversion to uninversion is roughly equal to the length of the recession that follows. And I think there's probably a good chance here that this recession is a slog, that not necessarily a really deep recession, but it's not going to be one of these things where we get this V-shaped recovery necessarily, like we saw with the housing crash, and in particular, what we saw coming out of COVID. The other canary in the coal mine is the 10-year, 2-year treasury bond. You can see we've uninverted and we're reinverting, and we are very, very close to uninverting. So again, that could start the recession countdown. Guys, I don't want you to think recession. You know, I feel like we should be Eskimos and we should have multiple words for, snow just like they do. We need multiple words for recessions, because is this going to be a bad recession, a mild recession? We don't know. All we know is a recession is coming, and historically speaking, there's never been a positive stock market in a recession. And so that's why we focus so closely, especially on our risk adjusting models, on whether or not a recession is coming. Now, good news is, there's always an opportunity out there, and that opportunity looks like it's bonds. Bonds absolutely got slayed during the rising interest rate environment of 22 and part of 23. So there's an opportunity there to go buy high quality stuff that's finally paying decent yields, and likely you're going to see some nice appreciation. So historically, bonds like inversions. If you look here in the early 80s, this is that tail end of that hiking cycle you saw in the late 70s because they cut rates too soon. And so what you saw during that inversion, here we're looking at the 3-month versus the 10-year, it was massively inverted at 2.63%. You saw some really, really nice 24 and 60-month trailing returns from the inversion forward. We're looking at a similar spot here. Historically, bonds like Fed pauses, which is where we're at. We've had 3 Fed pauses in a row. And what you can see here is it's a real positive environment, with the exception here of what are we looking at here? 2000 to 2001 for global aggregate bonds. Well, we'll just avoid global aggregate bonds right now, at least. We're looking more at high quality treasuries, high quality corporates, and some other more or inflation neutral type assets, which we're going to talk about a little bit later. And what I absolutely love is the opportunity here that exists if the Fed cuts rates, which eventually they should. I want to say it's about 10 to 12 months from the last hike to the first cut historically. So once the Fed starts cutting rates, all those existing bonds, the ones that you're in right now, clients, if you're in the risk adjusting models or any of the other models for that matter, those bonds are at higher rates than the newly issued bonds at lower rates. So those higher rate bonds are much more attractive now. And so the best story I can tell here is 1981, 1982. 1981 was the last year of the rate hikes under the Paul Volcker. He was chairman of the Fed. Prime rate topped out at 21.5%. To put that in perspective, today, prime rate is 8.5%. You can imagine the pain that was being felt in the mortgages and all the borrowing at that time. Well, they finally indicated they're done raising rates. So you saw investors piling into bonds in the second half of 81, and then they cut rates in 82. And bonds, we're looking at the 10-year Treasury bond here, incredibly boring investment, puts up almost 33% in 1 year. Now, I don't think we're necessarily going to see that kind of return because we did take prime rate to 21.5%. But I do think that there is some substantial opportunity in the bond market in 24, maybe 25. It all depends on how quickly things move. Now, some other good news is the building of manufacturing facilities. One of the #1 topics among CEOs on their earnings calls was re-onshoring manufacturing. You're seeing manufacturing leave China in droves. In fact, Mexico, we now import more manufactured goods from than we do from China. And you're seeing them bringing it back to the United States as well. Well, that's really been helped from the infrastructure bill, the Inflation Reduction Act, as well as the CHIPS Act. In particular, we wanted to bring that semiconductor manufacturing back to the U.S. just in case China does invade Taiwan. We realized during COVID the vulnerability that we had when the semiconductor production stopped. We had all those vehicles, for example, that were brand new, sitting, waiting for their microchip, and they sat there for probably a good 12 to 18 months. So this is definitely a bright spot. But again, this has a little bit of a shelf life here because it's only until the government infrastructure deal money runs out. So I'm not sure when that is, but just something to keep an eye on. So let's get into the actual strategies. What are we doing in each one of these? So starting out with really our flagship, where the vast majority of our clients are. If you're retired or close to retirement, or you're taking systematic withdrawals, this is really going to pertain to you. So the risk adjusting models, I'm going to talk about the growth portfolio. This is our classic moderately aggressive portfolio. Important concept. It is about 80% stocks, 20% in bonds. That's where it wants to be. That's its happy place. We call that its bias. But right now, because of where we're at with the extreme valuations and everything else I just named, it is in minimum aggression. So it's gone risk off. It's heavy, heavy, heavy in bonds, high quality bonds, and corporates and treasuries. We'll probably be adding some more treasuries later, according to Morgan. So that particular strategy we described has gone risk off. So if we do get the sell-off and we go into the recession and the stock market's bad, this strategy should benefit. And if the Fed starts cutting rates because we're in bonds, it should benefit as well. So we're pretty excited about the opportunities right now. Being defensive is also being defensive and opportunistic at the same time. A very unique time period for us. The tactical allocation model, not really much has changed since we last did an update here in the thirdly. What you're seeing right now is this particular portfolio. Again, this is the growth or moderately aggressive tactical allocation portfolio. Now it has a bias of being 80% stocks and 20% in bonds. But the way its formula runs right now, there are enough stock sectors with a positive 2-year forecast in excess of the risk-free rate of return, which is the money market, which is currently paying 5.23% as I'm doing this presentation. And so the runner-up, it parks at a money market. Why not? That's almost bird in the hand at 5.23%. So I like to think of this as dry powder. There's 56% in select stock sectors and 24% sitting in money market, collecting about 5.23%, and the remainder is in bonds, high quality and more safe bonds on that. The global allocation model, or as I like to call it, the go anywhere model. This is definitely our more reactive model. It does not have that macro overlay. Should I be risk on or risk off? It just completely removes that and says, of all of the sectors I pay attention to, I don't care if it's a stock or bond, who has the best 2-year forecasts, that's where I'm going to be. And what's really interesting right now is there are opportunities on the stock side, it sees, there are opportunities on the bond side. So those of you who are between that retirement and you're not, in the wealth accumulator models, just starting out, this is a pretty unique strategy here. We're really excited about the prospects because we just launched this strategy back in October. The wealth accumulator models, this is going to be our most aggressive strategy. These strategies do not respond to everything I just talked about. That's all, as I said earlier, short-term noise and a long-term plan. The growth portfolio, to keep it consistent, 80% stocks, 20% bonds, and it really just doesn't care about anything I said earlier. It is going to stay the course. This is better for young investors. If you're making regular contributions, I like to say that time and contributions are your risk management here. Yes, it will make changes to what stocks and what bonds periodically that are in the portfolio, but it's not responding to these short-term moves. So to recap everything, consumer is struggling. It appears inflation has been slayed, at least for the time being. Hopefully we don't repeat the 70s. And maybe interest rates are on the decline. We'll see. I think the Fed might hold them longer. But again, if you look at it, this is going back to 1970. Despite all the crazy events, somehow the market continued on. So I don't want us to lose sight of the fact that the market does climb this wall of worry. It's really easy to watch the news and get scared into cash. So if you're concerned about that, don't hesitate to give us a call. You can visit our website, you can give us a call, or you can actually sign up for our e-newsletter. In fact, we'd love for you to sign up for our e-newsletter. That way you'll also get these videos as well. Thank you for listening today. If you have any questions or concerns, please don't hesitate to contact us. We're always happy to help here at Comprehensive Wealth Management.